Greetings from Edmonton. This is where I'm at today. And sorry, here you go. The sound is should be on right now. So as I said, apologize for my voice. I was fighting a bit of a virus now, and it seems to have developed overnight. So I'm gonna have my water, and I'm gonna have to take a few sips here and there, and hopefully it can last to the end. In terms of, so Brent was mentioning that we're going to be um, uh, taking some questions, and so hopefully I'm going to leave some time. Not hopefully, I will definitely leave a bit of time um, for questions towards the. Um, you have plenty of questions, so please do share your observations and your questions. And if there's something that I'm not addressing or something that you feel deserves a little bit more discussion, I'd be really happy to answer your thoughts. In terms of presentation, this today is just a little bit of the outline that I have in mind. I'm going to start really broad, and I want to mention when I say macroeconomic environment, I really want to mention interest rates and the value of the Canadian dollar. And I'm going to shift over to baseline for ag, so really looking at farm income trends as well as farmland values. And then finally, cover a few sectors: red meats, grains, oilseeds, and dairy. And even if your sector is not there, then I'd be happy to answer any questions you have. So keep that in the back of your mind. This is sort of the storyline that I have planned for the next 30 or so minutes. I can't really start more broadly than this, right? So this is the picture for the world economy. You see at the top, it says global GDP, so that's gross domestic product. And this is the one statistic we use to actually um, talk about the health of the economy worldwide or within a country, for example. In this case, it says 3.9% as a forecast for 2018. That one forecast has been going up for the last 12 months, basically. We were at 3.7 not too long ago, 3.5 before that, and 3.3. And so the bottom line is that the world economy is really definitely improving. The outlook's improving for 2018, definitely. And I think that's a huge positive when it looks at ag markets, because one of the theme today, I'm going to be emphasizing this quite a bit, is that there's rising production worldwide, especially, no matter where you look, whether it's crops or livestock. And the strength of demand coming from especially external markets, but as well our own domestic market here in Canada, but as well as outside of our borders, is absolutely critical to be able to sustain a profitability we've seen over the last few years. So I'm not going to get into the details of bombarding you with numbers, but this picture actually says that the world economy is actually doing better. The growth is there, and it's picking up pace. So I think that's a pretty good sign. Now, when you look at our own economy here in Canada, I used to say not too long ago, maybe 3 months ago, that it was a glass half full, half empty type story. But you're looking at the data right now, everything that has come up has actually been pretty good. And whether it's the labor market, you'll see that in the next slide, whether it's our trade balance, whether it's businesses being more optimistic. There was just one statistic that came out today, or not today, this week, with regards to a trade balance in Canada, and then sort of making a point that it was a negative story, but actually, our trade balance is worsened a little bit because we're importing more machinery and equipment. And I think it speaks to the outlook of the businesses have overall across the country, and we're seeing a lot more optimism from businesses across the country. And I think this leads to more business investment, and so growth is picking up. Now, obviously, you still have a few headwinds, one of which has been there for a while now, and that's consumer debt, right? It keeps on increasing with regards to disposable income. So it's not just a matter that household debt keeps on increasing, but it's increasing faster than income. But yes, that's a headwind, but overall, the economy is really doing better. I was mentioning the labor market. I think on the next slide here, you're seeing unemployment lowest it's ever been for the last 10 years. Definitely, picking up the pace or accelerating in terms of the strength of the labor market. If you look at the last 6 months, job gains, and so there's just lots of positive, right? So the flip side of all that, though, and that's what I emphasize, that's what I want to emphasize, is that it led the Bank of Canada to raise interest rates, right? So we've had 3 rate increases over the last 7 months. And so on this chart, we get a few things to notice here. Well, one of which is, first of all, the blue line is what we call average borrowing costs across the economy for businesses. So it's not just the ag sector, it's businesses across different sectors. And it's the average of all the different interest rates or the different products that are available out there, right? So think short-term interest rates, long-term, fixed, variable rates, all of that, put that all in the same basket, and then you come up with an average, right? So that's what the blue line basically is. And so if you start on the far right, you see where there's a green arrow, that's when the Bank of Canada actually increased their overnight rate, their policy rate. We've had 3 increases over the last 7 months. We've had one in early 2018. If you look at the middle of the chart, that's when the Bank of Canada actually cut rates. And we had an oil price starting in 2014 that started to fall quite significantly. Then the bank felt that it needed to put a bit more stimulus when it came to interest rates and lowered their interest rates. But right now, for the last 7 months, as I was saying, 3 rate hikes. A couple of questions. One of which is, what about for 2018? What can we expect from the Bank of Canada? Well, I have to say that we're likely to get another rate increase, perhaps as early as between now and March, April. If you look at the financial markets right now, the probability of seeing another rate hike is about 50%. So it says that, yeah, the Bank of Canada is likely to raise interest rates once again. Where there's a bit more debate or less consensus, I should say, is what happens next. And then depending on where you stand, you could say, well, there's going to be another one in 2018. So for a total of 3, remember we already had one in early 2018, maybe another one March and April, and then maybe another one towards the end of the year. So that would make 3 rate increases in 2018. Others, like myself, think, well, there are reasons to believe that the Bank of Canada may not have to increase rates. I mean, anyway, not too fast. Part of the reason what is going on in the United States now is lagging or is behind us in terms of the pace of rate increases that we've seen. And maybe, just maybe then, I think there's a cause here or reason to actually pause after we've seen the next rate increase. The second point I want to make is that just no matter what the Bank of Canada does, whether it's going to be 2 more rate increases in 2018 or just once, rates can actually increase no matter what the Bank of Canada does. The best example of this is what happened in the middle of 2015, where you saw the blue line move up without the Bank of Canada doing anything. What was happening then was that there was rates were tend to move up a little bit, or were moving up a little bit in the United States, based on the belief that the central bank at the time was going to withdraw some stimulus in the economy over there, and so on. So rates moved up across, the U.S. as well into Canada as well, because we have integrated financial markets. And then when the central bank decided against actually withdrawing some of the stimulus, you've seen at the beginning of 2016, all the way to almost the middle of 2017, you've seen rates drop. With the result that sometime in the summer of 2017, we had the lowest interest rates on average on record in Canada since we started collecting data about interest rates. So you can go way back before 2013, actually. So it raises a few questions, especially at a time where farm debt keeps on increasing in Canada. We've made some significant investments in the farm sector, and that's good because we need that from a productivity standpoint. But it does, I think, raise the question of what to do next, or what to do in 2018 for the next 12 to 18 months in terms of potentially managing financial risk. A business, for example, that would have taken on a loan with a 1-year term, fixed rate for 1 year in the summer of 2017 would have, as I said, basically got an interest rate that was really low. But now, when it will be May, June, when it comes time to renew the loan, will be faced with higher rates, perhaps as much as a full percentage point higher interest rates. So it does create create a situation in which I believe it is important for businesses to actually look at their financial situation, look at where they stand, and run some scenarios in terms of income, in terms of interest rates, and see how your ability to actually meet your financial obligations evolves as rates move up. But I'm not so sure that we can call it a trend so far, or certainly not a long-term trend. I think from a historical perspective, interest rates remain very low, but the economy is approaching full capacity, and at that time, it's totally natural to see the central bank or the Bank of Canada raise rates in that sense. Now, the second impact of all of this is with regards to the U.S.-Canada exchange rate when it comes to our currencies. Right, so this is the value of the Canadian dollar, or the value of U.S. dollars per Canadian dollar, right? So as the line goes down, our currency is actually depreciating. When the blue line moves up, our currency is actually gaining value against the U.S. dollar. Now we have a situation in which our currency is just above 80 cents. A couple of reasons for this. One of which is that, as I said, we've started to raise rates before the United States. I do believe at one point in 2018 that the U.S. is going to catch up to us, and that should alleviate a little bit of the upward pressure we've seen on the Canadian dollar or the exchange rate. Another thing as well is that oil prices have been moving up. Now if you look at the headline, I put oil steady or oil price steady, and then between parentheses there a question mark. Right now, we've seen oil prices move towards a $65 mark. I really do think that we're likely to see oil prices retreat back in that $55 to $60 range. Part of the reason that we've seen prices move up is because of the ability of oil-producing countries to limit production, they did implement production cuts to sustain higher prices, but historically, it's been really hard to enforce these production cuts. And so I fully expect that as we're going into 2018, we're likely to see the oil price retreat back a little bit. So if the oil price does not go further up than where it is right now, and indeed the U.S. catches up to us with more rate hikes than we have in 2018, I'm fully confident that the U.S.-Canada exchange rate will stay below 80 cents. That's the assumption that at FCC we're working with right now. It's definitely something to monitor. But I'm fairly confident that towards the end of the year, we're likely to see the Canadian dollar drop below the 80 cents threshold. I'm going to get back to that later on because I do believe that that's something I've emphasized now for more than a year, actually. But I do believe that Canadian dollar has a big, big impact on the profitability of different sectors, if not all the sectors. I would even argue that the dairy sector, for example, is actually exposed to or as profitability that's function of the exchange rates. I can go back to that later on, but I think most sectors have a vested interest in seeing the dollar below 80 cents. Now, obviously, if you're looking to buy equipment, if you're looking to make some investments there, you would perhaps prefer to have a dollar above 80 cents. But overall, generally speaking, I think we're better off in a low Canadian dollar environment. Want to say, given that we're talking about the global landscape here, I want to say a few words about trade agreements. Now, there are just tons of things that are happening there. Quite frankly, more questions than answers at this time. I'm just going to grab a bit of water, sorry. More questions than answers at this time. But I really do think it's important to monitor what is going on. Now, we've got a trade deal that was agreed upon, which is a revised version of the previous Trans-Pacific Partnership Agreement, TPP, which is now labeled CPTPP. Potentially a signature coming up in March of this year. I would think that, given the time for all the countries to ratify this and so on, that we're not likely to look at implementation before 2019. The details right now are still not official. There have been a lot of reporting on this, and so I'm working with what has been available, but I think it's quite clear that we're going to get lots of different opportunities when it comes to red meats and grains and oilseeds, especially when it comes to the Japanese market. especially given that the U.S. is not part of the deal. I think that's one of the biggest drivers right now is in all of this, is that the fact that the U.S. has actually decided to stay out of it, which opens up opportunities for us. If you think of the red meat, for example, in Japan, a high value market for us, where we're competing really hard in the fresh and chilled pork product space, for example. I think there are some gains there for us to be made. I do believe that grains and oilseeds, same thing, same kind of argument. There's also the markets like the Vietnam and the Malaysia markets that are actually fast growing. So it does open up opportunities. At the same time, it does create a bit of more market access. Although we don't have yet the official number, it looks to be quite similar to what was agreed upon as part of the previous TPP. So I'm very careful here to come up with numbers that are not yet confirmed. It looks as if there'll be more market access conceded to poultry products as well as dairy products from other countries. I can go back to that later on. I am fully, I'm anticipating that the industry, the poultry and dairy, will be able to adjust to more foreign products coming in Canada. I mean, obviously, from the perspective of these sectors, you would like to be able to produce these volumes and not, giving it up to foreign businesses, but foreign suppliers. But at the same time, given all the increase in production that we've seen in poultry and dairy over recent years, I fully expect these sectors to be able to adjust to concessions that will be made as part of the new TPP. The other question, obviously, is what is likely to happen with negotiations around NAFTA. Couple of options. Either we end up modernizing, coming up with tweaks to the actual NAFTA agreement that will make, hopefully, NAFTA a better deal for everybody, or the U.S. simply walks away, as they've actually been on the record saying that there's a possibility, definite possibility, that they're willing to actually walk away. Tweaks to NAFTA, I don't anticipate would actually change a whole lot when it comes to ag markets. Obviously, we need to look at what kind of concessions we could be making in terms of dairy, if at all. In terms of dispute settlement procedures, is something as well that we've benefited from, the ability to actually challenge some U.S. policies that were not, in our opinion, consistent with their commitments with regards to trade. So those are important things for sure. But if we do end up tweaking the current NAFTA, I don't think this would have much impact. Now, if the U.S. withdraws, I think it opens up more questions, really. Does the president in the U.S. has the ability? Does he have the ability to actually do this on a unilateral basis? What do we go back to? What's the fallback, right? Do we go back to the FTA we had with the U.S.? Because we did have, prior to NAFTA, we did have an FTA with the U.S. Do we fall back on WTO rules, which would imply that there'd be a bit more taxes at the border on what we export to the U.S.? That's another question that is worth asking. What happens to the Canadian dollar? You would expect to see the Canadian dollar drop a little bit if the U.S. withdraws, because that's going to have an impact short term, I believe, but nevertheless would have an impact on the Canadian economy, and I would expect to see the Canadian dollar drop, but which in some ways could make up for some of the trade taxes we could see at the border. So I don't think that's necessarily a bad thing. And then there's just tons of secondary impacts. And I'm mentioning corn prices here. Think of that, right? So 40% of the U.S. corn supply goes to exports. Out of that 40%, a third goes to Mexico. So what if Mexico says, well, we don't want any of your corn anymore? Where does that corn go? And right now we do have, if you look at Western Canada and Alberta, for example, we do have a bit of U.S. corn that's now competitive with Canadian feed barley. So, would we expect to see more corn in Canada, more U.S. corn in Canada? I mean, those type of things, what would be the impact on U.S. corn prices? And then I would feed into, prices in Eastern Canada. So there's just tons of questions, more questions and answers, really. But those are the things and that are worth monitoring. And I would say, I think one of the takeaway for me is, and I think if in terms of risk management, I think this year, perhaps more than in any other years, given those broad issues that are being mentioned and discussed, I think any type of risk management strategy when it comes to marketing commodities, I think, is more important than ever. So that would be my takeaway when you think of potential impacts of trade negotiations like NAFTA, for example. So I want to shift over to a baseline, what I call a baseline in ag. So basically looking at what do we foresee for the next 12 to 18 months in the ag markets. Now, before I get to farm income and farmland values, we'd like to point your attention to this particular chart. Now, this is a chart that I've started to use for more than a year now. So I may actually, for those of you that have seen this webinar, actually have used it last year. And there was a lot more green than red. Red means that current cash price is lower than the 5-year average price for that particular commodity. Right? Green obviously is the opposite. We got a cash price higher than the 5-year average. We all know that ag is a cyclical market. It's just that we are not exactly sure how to predict those cycles, but ag has been a cyclical business for as long as everybody can remember. So it's not necessarily unusual to see a picture like this, but it does speak as to where prices are in terms of the overall stage of the cycle we're at. And I think we're probably towards the bottom of the cycle. I think for a lot of those commodities that are listed there, I think we're probably seeing or expecting to see a bit of upside over the next 12 to 18 months. Not so much though, because, like I said, there are plenty of supplies in the marketplace, but I would expect a bit of upside then, and certainly in the next 12 to 18 months. Now, another thing to point your attention to is top line, corn in US dollars. You can find corn in Canadian dollars towards the middle of that chart. Do the same thing for soybeans, do the same thing for wheat. And anytime you look at a commodity in Canadian dollar versus US dollars, you'll find that the one in Canadian dollar has been less, the price pressures we've seen in the marketplace when expressed in Canadian dollars have been less important than the ones that are when measured in US dollars. And there are plenty of different reasons for that. But by far, the biggest driver has been the US to Canada exchange rate, right? So the exchange rate between our two currencies has played a really big role in shielding us from from the significant downturn that the US has gone through in 2015-16. And now it looks as if 2017 is going to bring a bit of stability to US farm income. But it's been 2 to 3 difficult years in the US from a farm income standpoint for sure. In our case, if you look at our projections from Canadian farm income, this is gross receipts. Couple of things. Now, 2017 still technically a forecast because we don't have yet the last 3 months of data. We think we're going to end up higher than 2016, so we're still seeing a bit of growth. It's not as significant as perhaps you would have seen 06 to 07, 07, 08, or 11 to 2012 to 13, or 14. But it's still growing, which is good news. Making some assumptions about the value of the Canadian dollar, as I said just moments ago, looking at what future markets are telling us, making some assumptions about yields, seeding intentions, those type of things. We end up with a forecast for 2018 that's not bad at all, actually. Another break and another record when it comes to farm cash receipts. But one other thing, though, on the flip side of all that, despite how positive this looks, I think it's also it would be unrealistic to have expectations that our farm cash receipts are going to grow over the next 10 years like they have for the past 10 years. We've had tremendous, never seen before growth when it comes to gross receipts at the farm level. We've been able to grow the farm economy quite a bit. I do believe we're going to be able to grow it further over the next so many years, but maybe not at the same pace as we have in the past 10 years. So that sends, I think, the one key lesson there is when it comes to farmland values. Now, this is a picture for 2016 across the country, coast to coast. Our 2017 study at FCC is going to come out, I believe, the 3rd week of April. So we don't have yet the numbers for 2017. I have a little bit of an idea for the first 6 months of 2017. And we still showed or recorded then in most provinces, I would say, an increase in farmland values for the first 6 months of 2017. Not an increase as significant as you're seeing there for 2016. But then the question becomes, what about the last 6 months of 2017? And the last 6 months, the last 6 months of 2017, we had two rate increases. We had one in early 2018, and we had two in the last 6 months of 2017. So it's unknown to me at this point how significant this will be on the overall farmland market. I do believe there'll be an impact. I believe the impact will be not that great. So I'm still, showing here a forecast of between 4 and 5% increase in farmland values. So definitely a slowdown in the pace of increase we've seen. This is the average at the national level, by the way. National increase, annual increase at the national level, I should say. And then 2018, given higher rates, given farm income that, is still projected to grow, but maybe not as fast as we've seen in the past. Still projecting farmland values to go up, but at a slower pace. Ideally, not ideally, but in a market where it will be in equilibrium, you would expect farmland values to grow roughly at the rate of productivity growth plus inflation. Our productivity in the crop sector has been going up at an average of 1.5 to 2%. If you take a long-term average over the last 30 years or so. So 1.5 to 2%, another 1.5 to 2 when it comes to inflation gives you something in between 2 and 4%. So the question I get all the time is, will we be able to sustain the large increases we've seen in the farmland value market? My answer is always, well, are we going to be able to sustain farm income? Because if we are, I do believe that we'll be able to manage the increase in borrowing costs that we've seen and we're likely to see in 2018. If you look at our financial situation in Canadian agriculture, we're sound. First line of defense always been working capital in my mind. Second line of defense is how solid your balance sheet is. And you look at the different financial ratios for Canadian ag, we're still comparing favorably with regards to all those ratios behaved historically. So I think we're in a good position to face the higher borrowing costs. I think one of the keys is, are we going to be able to sustain farm cash receipts and farm income and net farm income? And part of the key there is growth in a strong, it's a strength in demand for commodities and the value of the Canadian dollar. So I'm going to talk about that later on when I talk about different snapshots. But I do believe we'll be able to sustain farmland values. But I think it'd be unrealistic as well to expect that we'll be able to grow farmland values the way that we have 07, 08, in 2011 to 2014, 15. I think this is something that happened then because we were growing farm income real fast. I think now it's time to have more realistic expectations of how the farm market, because that spread between farmland values and income, you don't want this to go too far, right? You want income and farmland values to move together. And lately, that farmland values have been moving faster than farm income. Okay, sector snapshots now for the next 10 to 15 minutes. So I'm going to start off with crops, grains, and oilseeds. Like I said, I could bombard you with numbers. You could look at global production of soybeans and oilseeds moving up at a pace of 4 or 5% for the past 5 years. Wherever you look, whether it's U.S., South America, and I know there's some issues with weather in South America, but wherever you look, you take not a long term, but just look just at 1 year, but 3, 4, 5 years of data. It's quite clear that production is rising everywhere. Black Sea region, everywhere. And I think it says something about, well, we need demand, right? And I know there's quite a bit of, I know, some people are kind of tired to hear about China and the impact it has on the world markets. Well, it does, right? Because China absorbs half of all the increase in oilseeds on an annual basis, or basically going to China. So as long as China can sustain that pace, and as long as we have quite a bit of strength in world demand, I think we're going to be okay when it comes to the pricing of commodities. But to me, it really, and this is me here with this particular slide, trying to be a bit creative, which I'm not. So it's the best I can do. And shift in paradigm. Paradigm is a big word. It just really says big. A shift in mindset is really what I'm after here. I think we need to realize more and more that, in order for us to grow farm income, we're going to have to, it's going to be coming from volume, not pricing. I'm hoping for a bit of upside. That's going to be limited if it comes at all. in terms of 2018, unless there's a disruption weather-wise. But it's highly uncertain, and I wouldn't want to rely on disruptions in weather that are totally unpredictable, basically. So really, to me, I think the mindset is, are we growing our productivity? Are we positioning ourselves to be able to grow our volume base? Because other countries are growing, and I think that's a shift in mindset that is required here when it comes to growing farm income. Now, if you put everything in perspective in terms of where profitability or how profitability looks, so starting in Eastern Canada, looking at corn and soybeans, I'll go to Western Canada in just a second. But looking at Eastern Canada, we're looking at corn being tight. And then oilseeds, obviously, soybeans in this case, offering a bit of profitability. The number that you're seeing at the bottom in red are actual initial estimates of what acreage could do in 2018 as computed by AAFC, so Agriculture Canada. We'll see how these evolve. I mean, I'm curious to know if we're going to get 2% more corn in Canada. Those are national numbers, because right now corn is pretty tight. Doesn't offer a whole lot of profitability. Now, there are tons of it. I got to say, there are tons of assumptions behind these charts, right? So please don't necessarily compare your operation to these, because lots of assumptions with regards to yields, structure, cost structure, pricing, value of the Canadian dollar, basis levels. So, but I think this basically sends a point, right? If we make these assumptions consistent with each other, then it sends the message is pretty clear that there's a bit more upside to soybeans than there is for corn. When you look at Western Canada, before I go to profitability and the same kind of picture for margins, you got trade frictions with India. I'm not super optimistic that these are going to get solved or resolved in 2018. So as a result of those taxes and frictions we have with India, our ability to export and be competitive is actually less so. And we've seen price pressures on pulse crops here in Western Canada. The big question is, what is this going to do to seeding intentions, right? So seeding. So keeping that in mind, this is what the picture in terms of profitability looks like for 2018 in Western Canada. And what you're seeing, again, those are estimates by Ag Canada in terms of seeding intentions of the numbers at the bottom. One of the things that is not there when you look at Western Canada is the impact of the lower acreage for lentils and peas on soybeans. I fully expect soybeans to continue to grow significantly in Western Canada. I wouldn't be surprised that 2 years, 3 years, maybe from now, we're going to get more acres of soybeans in Manitoba than we're going to see in Ontario, which is kind of pretty telling, actually. Soybeans are still going to make some headway in this year in Saskatchewan, I'm sure. But again, profitability type, wheat, and then it opens up a little bit when it comes to canola. But as we're getting more into the year and we're getting a clearer picture of what seeding intentions could look like, I fully expect that the margins for canola are going to actually shrink a little bit. If indeed we get 4% more canola acreage, that'll be a record year, and I would fully expect that margin to actually shrink. So something to keep in mind, that this is the picture as we speak right now, given what we're seeing in futures markets. That could change moving into or closer to April or closer to spring. When it comes to cattle, I think the biggest story there is the production volumes that keep on increasing in the U.S. It's just amazing. The 2018 forecast is more than 5% growth in the U.S. beef supply. Got some cost of production issues both in the U.S. and in Canada when it comes to feed, for example. In the U.S., there's been some dry conditions in the southern part of the U.S. But the biggest story, which I think is underestimated and not necessarily mentioned enough, that's the strength in demand, both within Canada and the U.S. and also beyond our borders. It's quite clear, in the U.S. You look at the U.S. economy, when it grows like it's supposed to grow now, we're likely to see demand for red meat keeps on increasing. and that's what I fully expect this year. So despite some of the anticipated higher supply of beef being available, especially south of the border here, so in the U.S., profitability doesn't look too bad. It's actually, in some ways, again, risk management is important, right? So as you can lock in some profits in a world where you got rising supply, I think it makes a whole lot of sense to me anyway. This is a bit of the same kind of illustration as I did for crops, for instance, oilseeds. You got space, the spread between the red dot and the blue bar is the spread between pricing, 2018 average pricing, and variable costs. So I'm not including fixed costs because depending on where you are in the country, there's quite a bit of variation in your fixed costs. But you could probably add on another $50, $70 per head, depending on the size of your operation. If you're a cow-calf producer, but there's profitability for sure. When it comes to feedlot, that picture can looks positive at first, and as we get into the summer months, it looked less positive. But actually, I think it shows a well-functioning beef market because feedlot have an incentive, to bid of cattle up the way up to where profitability will be break even, will meet the break even level, because this particular cost of production model does include a cost of production or a margin for ownership. So to see something around zero to me actually says that it's a well-functioning beef market. So again, despite rising supplies, it looks to me anyway as if the beef market is actually showing some profitability. Pork is much of the same. Again, production expansion in the U.S. 2018 is going to be bigger than 2017 and 16. The U.S. pork market grows about 1% per year. So anything in excess of 1% has to be absorbed in the export market. So again, vested interest in seeing that we have strength in the export markets. In Canada, we've been able to diversify our pork exports significantly, which I think is awesome. And even, the Chinese market may not be as strong as it was in 2016, but I think there's still, in a fresh and chill or a high value market, I think there's good opportunities for Canadian pork there in China, despite the fact that we are likely to see a bit of a rebuilding of the herd there in China. So again, it's a matter of domestic and foreign demand remaining strong. If you look at futures markets, make some assumptions about the Canadian dollar. Look at a large flour to finish operation here in Ontario. So we're using corn as feed. I think corn has a bit of an advantage over barley in 2018. So we would obviously lower that profitability for a Western Canadian operation, or a smaller operation also would see profitability come down, perhaps as much as $20 per head. The bottom line is that I think we have for most of the year, aside from at the very end of the year, we do have futures markets that are telling us that there is some money there, there's some profits there, which I think is an absolute positive. But because of this rising supply, and any time we're in a rising supply environment, markets tend to be more volatile. That's a given. And so I would say again that risk management is absolutely critical. Just to emphasize, especially with crops and oil or grains and oilseeds and red meats, just to emphasize the Canadian dollar, how it matters, right? Just this little simulation here. On a per acre basis, when our Canadian dollar goes up by 1 cent, let's say from 80 US cent to 81 cent. So we're seeing a depreciation of a lower Canadian dollar. Then it lowers our net income. If you look at cash crops, think of standard rotation out east of grains and corn and soybeans, or out west a pulses, wheat, canola type rotation. Roughly $5 per each cent of movement in the exchange rate, right? So if you have an exchange rate of 80 cents and it moves up to 85, you would see grain and oilseed producers lose on average $25 on a per acre basis, just everything else being equal. So, and then you can do the same kind of deal, same kind of exercise for livestock. So the dollar does have an impact. It really does. And it's not just our ability to export. it also has a direct impact on profitability because of the fact that we're using U.S. prices as signals for Canadian prices, right? So it's we have a vested interest in seeing that the Canadian dollar is going to remain low. Dairy, continued strength and demand. I wouldn't be surprised to continue to see some production and quota increases. I'm not necessarily thinking that we're going to see as strong as we've seen over the last couple of years for sure, right? We've had over the last 4 years perhaps growth as much as 20%. So strong demand for butterfat. Let's not underestimate the impact of retail prices or the impact that retail prices have had on the strength of demand for dairy products. If you look at retail prices for dairy products, they've been coming down more so than general food inflation. So that gives an incentive to consumers to switch over to dairy, right? So, dairy is competing against other products out there. So, but a strong demand for butterfat. Obviously, the flip side of that is that still a surplus of skim milk. So our ability to find markets for increases skim will be absolutely critical. And I think the new pricing strategy has actually done its job in terms of stabilizing the market when it comes to stabilizing the price of milk. We have strong investment right now in the industry, both at the processing level as well as at the farm level, which I think speaks to the strength of the industry. So I'm absolutely positive when you look at margins in the dairy industry. Excuse me. We're saying basically because of the price pressures, we're seeing margins that are really tight. Those are margins for the P5 pool, so in Eastern Canada. If you look at the Western pool, margins there are higher definitely, right, than what you're seeing up here. Reason is that the share of industrial milk with respect to overall milk produced in the Western pool is less than in the Eastern pool, the P5 pool, which basically triggers less price pressure in the West than in the East. But having said that, still some, for an efficient operation, margins are still positive, but there is not a lot of room if you look at the average cost of production for dairy. So I think there again in dairy, I think, it fits really well the entire mindset of volume over price. I think this is what the dairy market has turned out to be over the last few years. It's a volume-driven game. Can you make sure to maximize your butterfat yield? Can you make sure to produce all the quota that you have available? And I think it's as likely to stay the same for a while here. So we're moving into 2018 and beyond. So if I'm just trying to summarize here, and I'm right at that 45-minute mark, so good timing here. I'm putting up, we on our website at FCC released what we describe as five important trends to monitor with farmland values, the global economic landscape, the investment both in processing as well as at the farm level, energy as well as retail. Retail is absolutely critical. It's significant when it comes to profitability in 2018. You can go to our website, look at our blog, find Ag Economics there, then you'll be able to read on these 5 trends and I try to summarize the impact of all these 5 trends on profitability for 2018. That was sort of my objective today. I want to make sure that my message is not confused with any potential. I want to make sure the message is as clear as possible. I'm absolutely positive about the outlook for ag. I am. I really do think that 2018 is going to be another good year. But at the same time, we have to have realistic expectations. There's a bit more uncertainty in the marketplace right now, which to me suggests that we have to be on top of risk management, both from a financial standpoint, if you think of rising interest rates, from a marketing standpoint, in terms of pricing, and also from a production standpoint, in terms of the idea that the volume is driving a lot of our profitability moving forward. So, but I remain totally optimistic because what we're seeing in terms of the demand for food is absolutely showing some good signs.